Alright, today is Wednesday, August 19th, and this is a post-market review for the stock market activities today. We have important developments in some charts and of course the Fed minutes, and we will cover that in details. But first, let's see how the indices closed. The Dow Industrial Average closing in the red by 85.19 points, or a decline of 0.31%. The Nasdaq leading the declines today with 64.38 points, or 0.57%. The S&P 500 closing in the red, a decline of 14.93 points, or 0.44%. How about the sector's performance? All closing in the red, no metals today. And shifting to the futures performance, you can see lumber continuing the march to the upside with no stop in sight. Sugar rebounding from a decline yesterday, but the story of course is in metals. Metals declining big today, gold, silver, platinum, palladium. The exception of course is with copper. Copper is still holding steady, even though we saw a surge in the US dollar today. And of course, shifting to the casino, to the options market, you can see that Apple, Facebook, and Target reserving the top three places in terms of volume. Apple with 70% of the options traded calls, Facebook 85%, Target 71%. Alibaba is a name here reporting tomorrow, and the options traders are betting for positive results. 75% of the options traded were calls. And at the bottom of the screen, look at this name, Freeport-McMoRan. Here is a name that I started investing in about a month or so before it was cool, and now all of a sudden it is a hot stock and everybody is chasing it. We will see how it will hold up if the dollar continues to rise. And now, shifting to the headlines that shaped the day. The first headline we got overnight, that Trump canceled all the trade meetings with China. He personally canceled them. Of course, we know that China is the one who canceled, and now Trump is saving face by saying that he's the one who canceled. China wants to wait until the outcome of the elections before they make any commitments. And speaking of Trump, of course, here we go, bullying Goodyear Tire and calling for a boycott against an American company for a very silly reason of not allowing MAGA hats in their stores. And of course, we saw earnings today from retail giants like Lowe's and Target and TJ Maxx, and the trend is very clear. Exception, of course, TJ Maxx because it's secular to clothing. But Lowe's and Target had very good earnings, a surge as we expected, of course. However, you see that the trend is heading lower month over month in the same quarter, meaning that as the stimulus started to dry up, you saw less activities and less purchasing, and that of course solidifies the argument that the economy is on life support. It needs more stimulus for consumer purchasing power to continue. Without stimulus, consumer purchasing power will continue to dwindle. I am not so bullish in these retail names because I think that after the stimulus is done, after all the home renovation projects are done, consumers will be more careful now as the crisis extends and as their savings resorts are drained. They will be more cautious in making purchases. I am not very positive on these retail names, especially given the upcoming holiday season. I think it will be one of the weakest holiday season that we've ever seen. Yet you can see from Lowe's results that they have spent over $400 million giving their employees extra wages. Here is an example of a company that appreciates its workers, gives them over $400 million in extra wages, and also manages to score a big quarter, massive revenues and massive profits. You can do both. You can appreciate your workers and you can score a big quarter. And of course, I prefer Lowe's over Home Depot because when you go to the stores, the employees are happier and more willing to help. You go to Home Depot, and it feels like it is a forced environment and the employees are pretty sad. And of course, we have important headlines from the Fed minutes. And the Fed minutes, of course, they're saying that the coronavirus will have a severe weight on the economy for a long term. The Fed sounded like they're tapping out and they're raising the white flag. After all the trillions that they have spent, they've only succeeded in inflating financial assets and real estate assets, but they've failed to save the economy. They failed in their first and most important mandate, which is preserving employment. The Fed says participants saw less improvement in the business sector in recent months, and they noted that district business contacts continued to report extraordinary high levels of uncertainty and risk. And of course, the solution is more spending, more liquidity for the markets, and hopefully somehow that would trickle down and translate into the economy, reviving its engines again. That is not how it's going to work. Here's another one. The federal government is now at 26.6 trillion bucks in debt. No biggie. A gain of more than 3 trillion during the pandemic as Congress and the White House rushed to get aid to those impacted by the economic shutdown. That has coincided with a rush to market of treasuries and is rising concerns that high levels of issuance could have implications for market functioning. This is exactly the problem. The government is addicted to the Fed's cocaine. The Fed buying its treasuries, billions and trillions of dollars of treasuries, and of course the Fed trying to manipulate the treasury yields. And now they're saying that, hey, we're not going to use bond purchases to control the yield curve. First of all, remember, the Fed has control of the shorter end of the yield curve. They pretty much have no control over the longer part of the yield curve, the 10 and the 30 specifically. We've seen that the 30-year bond bombed last week, meaning that investors have no confidence in the US government and they're asking for more yields for them to commit capital to risk it for 30 years with the US government, meaning that yields will likely go up and the functioning of the market will all be scrambled. While the Fed lowered their own rates, you see treasury yields rallying up specifically for the long end because investors have no confidence and they need insurance with higher yields. Of course, that would be balanced out. The higher yields go, the more attractive they will become for retail investors and for stock market investors. They will pull capital from the stock market and commit it to the safer asset in terms of catching bond yields. And that is how it's supposed to be to begin with. The Fed should not manipulate the government bond yields. And you saw from the auctions that the Fed is outbidding everybody and they're spending like drunken sailor, trying to make the auction not look as bad as it is. And of course, here's a tweet I released a while ago. The Fed and the federal government so far succeeded in saving 9.4 million jobs, meaning that we have regained 9.4 million jobs out of the original number that we have lost since the beginning of the pandemic crisis. Yet the Fed spent over 3 trillion bucks to get to that outcome. That of course translates to 319,000 bucks spent per job to save one job. And we know that the unemployment rate is still very, very high. This is exactly the problem with this drunken sailor spending approach to the economy, throwing liquidity all over the place, hoping that some will stick and trickle down to the real economy. Had the Fed and the federal government from the very beginning gave every American that lost their jobs 50 grand for the rest of the year, they gave them 50 grand. That's a year's salary. Now you're covered. Stay at home. Don't go out unless you need to. Wear a mask. We would have been already over this crisis by now. And it would have cost a lot cheaper than what the Fed and the government are spending right now. You spend 50 grand, you give 50 grand to each unemployed person. Here's a year's salary. You don't need to worry about more stimulus, more unemployment benefit. We're not gonna do that anymore. We're just giving everybody 50 grand, a compensation for lost salaries for the year. You would have seen consumer purchasing power much stronger, helping all these companies that are struggling to sell credits for future use, and there won't be as much need for government stimulus and bailouts. But again, the Fed has no clue what they're doing, and of course, Congress has no clue what they're doing, and they've decided that if you just open the floodgates and let the tsunami of money drown the economy, of course, a tsunami of fake money that we don't have, that will rack up as debt, somehow it will save the economy. So far, the Fed failed to save the real economy in Main Street. And here is the next piece of news. Of course, Apple hitting 2 trillion, and you've seen the celebration from the media. It was like watching corporate porn. They couldn't lick the boots of Apple any harder. And none of them, of course, raised the question, why is the company valued 2 trillion? Isn't that a signal and a sign for the mania and the bubble. None of them asked that question. They just celebrated and continued to lick the boots of Apple, saying how great it is, and they defied all expectations, and the bears' arguments are gone. Meanwhile, we know that this is a stock that is pretty much supported by share buybacks and by the Fed buying their bonds. The core business is actually declining and not growing. It's been stagnant, and Apple is now resorting to the mob business of shaking down app developers in the store for more and more fees because they cannot revive their market share again in the hardware business. Need I remind you, of course, that back in the dot-com bubble, Microsoft was the most valued company in the world, and it reached, during the height of the mania of the bubble, it reached $500 billion in valuation. That was a massive milestone back then, and a lot of people raised the alarm that this is a sign of the mania, a sign of the bubble, but they were ignored, and the argument was the future is the internet in the 2000s, and Microsoft will dominate and have a monopoly over the computers business, and therefore they're not only worth 500 billion, but they're worth 1 trillion, and let's keep pumping Microsoft stock. What do you know? The dot-com bubble bursted. All these stocks, Microsoft, Intel, Cisco, all the inflated valuations dropped down, and they never came back. In case of Microsoft took 17 years before reaching the 500 billion valuation again. Cisco and Intel never reached their peak valuations from the dot-com bubble. We are now in a different bubble, perhaps a bigger bubble, and someday you look back and you say, yeah, Apple reaching 2 trillion was a sign of the top and the bubble about to be bursted. And perhaps after the crash and after the bubble is being bursted, it will take years to come for Apple to reach that 2 trillion valuation again, just like what happened during the dot-com bubble. But I know what you're gonna say, but this time it's different. But you cannot compare it to the dot-com bubble. But the Fed, but the future. They said the same thing during the dot-com bubble. When they were warned about extended valuations, they said this is not the 80s. But the future is the internet. But the new millennium. But everything is gonna be Cisco and Apple and Microsoft. It's the same argument being revived again, and it will end the same way. You cannot justify these valuations with any rationale given the situation of the macro economy worldwide. And now, shifting to the heat map, as you can see, it was muted day all across. Financials fared a little better, but they were still muted, and they traded in the red overall as a sector. You can see the only shining star here is Target, right at the top right corner of the screen. Target had very good earnings. Of course, it is one of the biggest beneficiaries of the pandemic situation of the lockdown. However, you could argue that maybe the move is overdone, could be short covering. It doesn't matter. Target did very good. And now, of course, the burden is on Target to prove whether they can sustain the momentum in the next couple of quarters, specifically as consumer purchasing power continues to dwindle. And now let's track the rotation. What's going on with the rotation? We're not seeing anything. Red across the board. The tech sector versus the comeback sector. We only have few green shoots in few names, but the overall picture, both of them got hit today. And that is, of course, one of the possible scenarios that we have discussed when we came to the rotation conclusion. We said that there is a possibility of two scenarios: a tech-specific correction and an overall correction. An overall correction will hit all names equally. Every sector in the market will suffer. We're not seeing that yet. This is why we take it one day at a time, or we track the rotation and the movement one day at a time. We are not committing any major capital in opening big positions. All we're doing here is nibbling in some positions until further clarity happens. And I told you the technical indicators that you need to look at to confirm any rotation in the market. And now, shifting to the charts, let's start with the chart of the SPY. Here is a 15 minutes chart. You can see that we traded flat throughout the day. However, at the end of the day, after the Fed minutes, we flushed down in the red. We have seen the knee-jerk reaction of the flush down before during the VP announcement and then the market recover. So we will give the market the benefit of the doubt that it is capable of recovering and repeating the same thing tomorrow. A sustained decline, of course, will be very bad. And you can, of course, shift to the weekly chart to confirm any reversals and any change in trend. You will see that if we continue to trend in the red and the weekly candle closes in the red severely without closing in all-time highs. Do not celebrate too early and say, hey, we reached all-time highs. It doesn't count until you close weekly above it. And of course, you keep your eyes in the indicators such as the MACD specifically. Crossing the blue line, the average, making red impressions in the MACD will signal a shift and a reversal in trend. We are not going to discuss the NASDAQ, the triple Qs today because we have a similar look in the chart to the SPY. Instead, we will do the dollar index, and here we go. The daily chart of the dollar index, big rebound today. It is of course attributed to the Fed minutes, but if we dig down and we go to the 15 minutes, you can see that the dollar index started rallying at the beginning of the day. Yes, it caught a major bid after the announcement, but it was catching a bid from the very beginning because the Fed minutes, of course, as we know, leak ahead of time and some of those insider traders make their bets earlier. The question here is this sustainable or not? When we have the Fed making commitment now that they will not manipulate the yield curve via bond purchases. So does that mean that the Fed wants the dollar to rise and appreciate in value? How would that square off with their commitment to increase inflation? I think the Fed is very, very confused and they have no solid stance on what they want to do. They are shocked that they spent all these trillions of dollars and it didn't do anything in fixing the real economy on Main Street. And now they're just switching from policy to policy. We know that the correlation between the dollar index and the 10-year yield for the government treasury note is not conclusive, meaning that there is no correlation. The correlation is with the shorter end of the yield curve. So was this a knee-jerk reaction from the dollar and from yields to the Fed announcement? We have to see tomorrow and the remainder of the week to confirm it. And speaking of yields, here is a chart of the TNX, the 10-year note yield. And you can see the bull flag formation from a technical standpoint, which usually, of course, result in higher prices. And in this case, yields. If the Fed going to stop manipulating bond auctions and bond purchases, that would mean weaker demand on the higher end of the yield, specifically the 10 and 30-year treasuries. Lower demand results in higher yields because you have to offer higher yields to attract bidders to the auction. Of course, the zombie economists argue that when you see higher yields, specifically in the longer end of the yield curve, that signals confidence of the US government in the long term. That is absolute bullshit. When you have an auction in the 30-year bond bombing due to low demand, that tells you that the yields are trending higher, not because there is confidence in the US government in the long term, but because there's underconfidence. Investors are saying, pay me more yield if you want my money to be held for the next 30 years. That does not signal overconfidence. But again, these economists are zombified. They don't apply any critical thinking. They follow whatever is in the book and they come up with this conclusion. And now let's switch to gold. Gold got whacked today big time. And you can see from the daily chart, it did not even reach the higher end of that breakdown candle. It did the bear flag formation and now it's trending lower. Switching to the weekly chart, this is not a good look for gold. Trending lower, and as you can see, the MACD is about to cross the average and trend lower as well. There is a theory here that every time Buffett talks about gold or signals any positivity toward gold, that marks a top in gold. I don't know if that theory is true or not, but it's certainly playing on right now. I wouldn't be buying gold. I will give it a few more weeks to see where it wants to go. And now, switching to the VIX, you can see from a weekly perspective, the VIX is about to make a green candle. If the VIX succeed in making the first weekly candle in many, many weeks, that would be a very bearish signal for the market. And of course, we know, and I told you about the August volatility in the VIX. The VIX has a history of popping during August. And of course, you have to keep your eye on the MACD. Crossing to the positive line, trending higher, would mean a surge in the VIX. That would translate to more pain in the stock market. And shifting to the earnings, we had earnings of today, of course, from retail giants, and we covered that in the morning. But we do have earnings from Nvidia after the bill. And last time I checked, the stock is pretty much flat, down about 1% or so. The earnings were very impressive, as expected, of course. Now the battle is between traders to decide whether the valuation is worth it or not. We'll see that tomorrow and in the weeks to come. And now let's conclude with this important point. Can the stock market sustain its movement with no Fed intervention? I know this is anecdotal, and you're going to say, why would the Fed drop out? The Fed will never drop out from liquidity. But here's the thing. We have an election year heating up. And as the Fed continues to flood the market with liquidity, surging stock prices, that would make the current administration look good. It will make the Democrats' argument regarding the economy look very weak. So expect the Democrats to add some scrutiny against the Fed. Why are they continuing to flood the market with liquidity during an election year, thus manipulating the market? I expect the Fed to pull their foot off the accelerator for the remainder of the election season. You can hear from the Fed's tone today in the Fed's minute that they're basically saying that we have done everything we could in terms of our liquidity and borrowing power. We don't have spending power. They're urging the government to do the spending because borrowing and flooding the market with liquidity only inflates assets in the stock market but does not save the real economy. Spending, more stimulus, more handouts help the microeconomy in Main Street. And here is the proof. Of course, a lot of people say that the stock market doesn't matter because the stock market is different from the real economy, but the perception here is the most important thing. Take a look, case in point here, in the NBC Wall Street Journal poll. In the poll, Biden leads by 9 points. Big lead. However, when voters are asked, what is the top issue in your mind? 51% named the economy as the top issue for their voting decision. And when voters are asked which candidate does better in the economy or you trust in handling the economy, guess who did better? Trump did by 10 points. That is a massive gap, and it shows that the numbers from the headlines could be misleading. At the end of the day, voters care about the economy and they will vote for whoever they trust in handling the economy. It is mind-boggling, of course, that they trust Trump in handling the economy given the destruction that happened in the economy due to the handling of the pandemic crisis. However, and this is the important thing about the stock market, voters know that the stock market is not the real economy, but perceptions matter. When you have a stock market at all-time highs, you can manipulate and you can say this is the argument that we brought back the stock market, we can bring back the economy. This is, of course, the Trump administration's argument. And when the Dems say you have to vote for us to save the economy because you cannot trust Trump in the economy, well, guess what? The argument comes back. And here's a tweet from Pence bragging about the stock market, saying that the stock market at all times high. You, as an intelligent voter, an intelligent person, will say that doesn't matter because the stock market is different from the real economy. But never underestimate the stupidity of the average voter. When they look at the stock market, they say, oh, well, this administration is good with the economy. They know what they're doing. Look at the stock market. I don't know anything about the stock market, but look at the stock market. That means that they are trusted to handle the economy and they can do what they did to the stock market to the real economy. Therefore, the Democrats are not going to be very happy heading to the heat and the heart of the election season with the stock market at all times high. It defeats their arguments in the economy, the most important issue for voters to vote for. There will be scrutiny against the Fed, and the Fed will have to take their foot off the accelerator for the next few months until after the election. The question here, will the market hold? The market is addicted to the Fed cocaine, to the Fed crack, aka liquidity. They are a junkie, and without the cocaine, the market will have a fallout and throw a fit. You will see the market having a withdrawal. So I don't know how can all these so-called analysts be positive in the stock market giving these facts and giving the period we're about to hit in. I see more risk versus reward here, and don't be surprised if we start to trend lower. All these milestones of all times high, and Apple 2 trillion. We've reached every milestone we need to reach. Tesla 2000. Now what? You know that the mania of the dot-com bubble lasted about 166 days. We're getting very, very close to that milestone as well. The message here: be cautious, be disciplined, and time your trades accordingly. And if you have profits, consider taking some profits off the table, ringing the cha-ching button, and booking those gains. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.